Well, welcome everyone. This is the Markets Happy Hour podcast live in London on April 16th. And it is a salon style podcast. So we deliberately have a small room and we've got some bulls, we've got some bears, we've got some extremes of both of those. And we have ultimately some great macro thinkers, which was the goal. So this is less about me and my content, although I do have a little. But we'll take it through the same five lens that we take through all these podcasts, which are done weekly. And the real point here is to get debate going. So I have this microphone, which I will turn on you at any point whenever you want to speak. And the camera will just stay on me in terms of just for ease. But what is the point of the Markets Happy Hour podcast? Let me just interest rates, equity markets, geopolitics, and other asset classes. So we do have representation in the room who are deeply embedded in private markets. And that's obviously another asset class that we would always like to talk through. And in terms of the getting through these lenses, some of the sub themes that we clearly have today is we're going to speak about inflation, whether it has been tamed or whether, as we're hearing clearly with the war in Iran, we have got temporary spikes or transitory spikes, or whether we're into something just more fundamental. When we look at bonds, we'll ask whether the interest rate trajectory we thought was upon us is in fact now reversed or is a different kind of trajectory. And equally, we're going to talk about the BIFs, which now seem to be the problem in Europe. It's no longer the pigs. It is Britain, Italy, France. Now that more established, this is in the case of Britain and France, economies that are starting to show gaps in how their government bonds are trading. So clearly some concern around the stability perhaps of those governments and their abilities to pay it back. And we have a very strange phenomenon of equity markets hitting new highs, but we'll ask about the nature of that equity market strength and whether that is something that we can rely on. And as I mentioned, we have some bulls, some bears, not to give it away, but we're on different sides of the table. We can speak about that. And then one area I wanted to bring up in the other asset classes is real estate. There seems to have been a lot of hand wringing about real estate, particularly here in the UK. This week in particular, we know that rates aren't coming down. House prices seem to be struggling, seem to be stalling. Similar picture around the US real estate. And we'll ask whether that's a lagging indicator or a leading indicator, and whether it smacks at something that is more concerning around the consumer. Because all of this, the basic bottom line is, so what? Are we discussing, why are we discussing this? Not because we don't enjoy having a good debate, but equally we work for clients in various shapes or forms. And how should we think about this translating into the consumer the consumer experience? So let me just turn this around so we can see a little bit. So where are we in terms of inflation? Basically, where we thought we were is that we thought inflation was coming into check. We just had a sense from the US that this was now not quite as tamed as we thought it was. We know that we're looking at inflation in terms of energy prices really being felt at the pump particularly, but also just the overall oil price. And then the UK, we have had always higher inflation than the rest of Europe, but we're also seeing a more subdued, it's slightly more subdued case in the UK, but also a suggestion that food price inflation could even be treble by the end of the year. Some of this driven by the war and supply chain constraints. So I suppose that I'd love to now put it to you. Do you see this inflation as being a real problem or a transitory effect? And another thing I should bear in mind is that inflation expectations remain very high. And that's why we see this factor of inflation being people buying ahead. It's called pay it forward. People buying their tickets today, buying the house today, maybe not the house, but buying that expensive item today because it could be more expensive in years to come. So let's start with the inflation question. William.
Yeah, I've just come from a forum where there were 5 CIOs on a panel. They were asked a very similar question. They all said inflation is here for the long term and it's going to be higher than you think. I agree. The problem is there's such a consensus that maybe it's wrong. And if we have a big recession, then maybe it goes the other way.
And of course, we have had deflation kind of in the rings for some time. And I know I'm going to spend a lot of time in Japan where deflation was a problem for so long. So that's still in the end. And I suppose I'd love to ask those CIOs then, if inflation's here to stay, what are they doing about it in terms of portfolio construction? Because the traditional inflation hedges, if we put equity to the side, are also not looking particularly strong.
They were also asked that question and they struggled to answer it very much. I mean, the bottom line was a range of different assets and use derivatives to try and protect. That was the kind of common theme between their answers.
Does anyone disagree with that? I mean, I know we have some strongly bullish. Yeah.
Slightly. Inflation, UK inflation in particular, I believe, is going to be high for the next couple of years, but only a couple of years because there are so many other external pressures on it, and the main one being AI. And AI has the potential, let's not say it's going to, but it has the potential to lead to significant deflation, potentially even hyperdeflation. The one constraint on that is energy prices, but we're doing a lot towards that. But AI is going to disrupt literally everything we do. And if you remember, I remember Excel spreadsheets in 1990 completely transformed what we were doing as actuaries, transformed what they were doing as accountants. This is Excel spreadsheet to a new order of magnitude on steroids. And there's so many aspects. Anything that requires thought, time, management, organization is going to be changed. And one of the areas that people always like to feel that they're secure is in sales. That isn't changing, that has changed. You're no longer going to be selling to another person because the guy buying your product or service has got an agentic AI on the case and doesn't have the time to go for a nice lunch and discuss it. Consequently, I mean, literally everything is going to change. And if you can do it quicker with AI, then people are going to do it quicker. That is going to lead to significant dislocation and unemployment. I think in the UK, we are fortunately relatively well placed. Whether this was intent or otherwise, back down to Blair's policies of getting university education up to 50%. Best thing about a university degree is it teaches you how to learn, even if it teaches you nothing else. And I think our workforce is best equipped out of Europe to transition, because we are all going to have to transition. That includes me in my late 50s.
Stephen.
Inflation has been and always will be a monetary function. Technology is here to stay, and I certainly agree with you that AI is going to boost productivity globally, which we'll come to in a second about asset prices. But I think that unfortunately, particularly in the UK, the debasement trade is the one that concerns me the most, and that essentially is going to ensure that inflation is trending higher. And I think we're in for a very different era. You know, we had 40 years of essentially a bull market for inflation, 1980 to 2020 in broad terms. And I think we're now in an inflationary era. Is it going to be hyperinflation if the Greens get into a coalition with Labour or something like that? Or in France, if you have again, extremist presidents, May elections next year, these are all serious tail risks. But I'm very concerned about inflation.
Can you tell us more about a debasement trade as you see it? Because we are kind of getting to moving on to this economic vibe check, which I think obviously flows from inflation because it's the most visceral way we have of examining where we feel in terms of the economy. The US consumer, they don't seem to track the UK consumer as much, but the US consumer is at an all-time low. They're buying things forward. They're expecting things to be worse. This is before the energy prices trickle through. That's on the vibes. We've got some slides here showing about more workforce cutbacks, just to echo Stephen's point. Growth slowing at a global level. So even the growth number is a little more abstract and academic maybe than day-to-day visceral experience. If that's coming down as well, this is global growth, not US growth. Just going back to debasement.
Debasement means running permanent deficits. We already have a permanent fiscal deficit, and we've got debt to GDP of around 100% here, worse in many other developed markets. But I think some of the sort of real black swan events could be an attack on central bank independence. You know, we've seen it already in the US, and I think we will see it here because we have a single mandate. Maybe that will change. So that's where monetary policy, which at the moment has been the anchor, the assumption the central bank will tighten when inflation starts to rear its head. It didn't really work 4 or 5 years ago because central banks essentially misread the data or misread the situation. I think I'm more concerned that central banks will be packed increasingly with people that suit the political master's agenda.
Mhm.
In which case, I don't disagree with that. But what that means is that the relationship between Walsh and Trump, assuming Walsh does get appointed, is going to be absolutely key. He says he wants to contract the balance sheet. He may not be able to. And the reason he may not be able to is because the US financial markets are pretty fragile. Look at the repo spikes in the last 6 months, 12 months. And he may just be forced to carry on expanding it to keep them alive. But I think that relationship is going to be really, really interesting.
I think from my perspective, I think that's the exact tension. It's between inflation and deflation. It's between those two parts. And I think the one thing I can feel most confident about is that we will have inflation volatility like we have not seen for 40 years. And maybe our historical tools, whether that be monetary policy or otherwise, will be ineffective. And I think a big part of that, at least for me, is that a lot of that last 40 years was characterized by globalization and lots of other things that are no longer there, quite the opposite in place. And I think a lot of what's been driving, on the one hand, the deflationary kind of effects, including AI and tech and other things, but on the other side, kind of the fact that it's supply chain stuff. It's kind of the opposite of globalization. And I don't think that going away. I see it, we're just beginning. And so whether it's 3, 5, 10 years or a few decades, it's kind of learning to grapple with volatile inflation, not just around a little mean, but like in much more extreme measures. That's really bigger picture where I see some sense of confidence, but I don't know whether the next move is up or down. And I don't know where we'll be in a year or two.
I think given we have an audience who I'm sure has got an opinion on this, I think I wanted to ask to shift it to a little bit of the, before we go back into the equity markets, getting to that point you mentioned about deglobalization and supply chains, because this is the chart from KKR about resilience and their concept around the security of everything. And that's been a topic that KKR has had for some time, Henry McVeigh, and it gets to cybersecurity at a point close to Stephen's heart. I think your eldest son is maybe working in that, has been for some time. The cybersecurity, security of supply of energy, clearly a key supply. You mentioned supply chains and getting that secure. But I think we should remember that the reason for globalization was to get, because of comparative advantage, and it was to get our costs down. And I don't see that changing. And one of the suggestions around the current geopolitical friction is that it is a slowbalization or a slowing. But on the other hand, aren't new alliances being now forged because in reaction to the geopolitical developments? And equally, we talk, Mark Carney speak about the middle powers. Is this not a time for Europe to unite? We've just had a seismic election result here. We'll discuss that. It can be discussed in Hungary. Will this galvanize the middle powers in terms of some of their globalization, that they need to have alliances, or will it have the opposite effect?
So I think globalization is far from done. Globalization was embraced aggressively. It was never managed, let alone well. A case in point was one of the first outsourcing entities or events in the UK was a group called Electrum. It was owned by Cinven. It was electrical components, and they outsourced to China. Why did they outsource to China? Because the FD was taking his wife there to try and patch up the marriage, and ended up in Hong Kong and discovered that he could get his components made for a fraction of the cost. That was the only reason. It was a fluke. Siemens bought Electrum to do outsourcing. And I asked the guy, why didn't you go to Mexico or Brazil? The answer was, well, I didn't know Mexico and Brazil. I knew China, and they bought me to do outsourcing. So the US ended up outsourcing to China for a mistake. It was just because he was taking his wife to Hong Kong to try and fix things because she wanted to go there. It's serendipitous, but it was also bloody wrong. Go back 10 years ago, Mexican labour costs were 20% lower than China. It's now about 30%. If they're getting shale gas from the US, their energy costs are 50% lower than China getting oil from Russia. And if you want to import or export goods to the US, it's about 90% cheaper to do that from Mexico than it is from China. So there's a lot of reassessing what's happened. You've then got other aspects like Trump limiting the H-1B visas and saying you've got to pay 100 grand per annum to get someone in. Well, they're not going to do that.
It's not per annum.
Sorry?
It's a one-off charge.
Well, it doesn't matter. It's already had the trigger. It means that people are not coming to the US, they're staying there. And as AI has developed and as internet connectivity has developed, people don't need to come. So the fact that they're not migrating so much isn't actually an indication of less globalization. It's an indication of doing globalization a little bit more efficiently. And globalization is getting more efficient. Supply lines, we see a lot of the energy transition is about energy security, and that's going to happen. There are benefits to that, but this is all about globalizing more efficiently, because at the moment, to date, it's just been random and it's not been organized. And now it's getting much better.
Is there a case for saying that because they're going to be almost two worlds, a bipolar world with one based around America, one based around China?
Personally, I think that Trump is doing everything he possibly can to promote Europe and potentially Russia as well. I think it's going to be the EU. It's going to be centered around Western Europe. It'll be a tripolar, and it's going to be a multipolar world going forward. I mean, I know it's a long way behind, but you've got a lot more cooperation between African countries. You've got a lot more connectivity between those countries in road and tiny bit of rail. But there is more trade and more freedom of movement of labour, and they're progressing that way.
And a lot of that gets to the resilience point. I mean, why is China in Africa? Because of the need to source commodities and resilience. So I think that's the point. I suppose my question to push back on this resilience point, is this new? Or has it always been thus? That we know we have cybersecurity with Mythos being caged for 100 days to check on that. It seems that it's not that anyone has been blasé about their firewalls and their security. Is this really a new phenomenon, or is it just more of the same?
More of the same.
I think some Western countries have been pretty blasé about their own security.
You mean in terms of national security?
National security, well, defense, but also their energy security. Not necessarily cyber. I probably don't know enough to comment to say anything for sure, but you look at the resiliency of Western Europe, the UK relative to the resiliency of the US or China, and it's a totally different ballgame. And I think that's because of poor decisions that have been made over decades and decades. I mean, that's more political than a market's point. Moving away maybe from that, and I do think we're going to be in if not a two-pole world, certainly a multipolar world, probably led between the US and China, but with lots of sort of country states that play the two off each other. India probably comes top of mind for that. But I think there's also a huge amount of investment opportunity in that. When we're quite bullish on emerging markets and particularly on frontier markets. And if you draw a circle roughly from the Middle East to encompass Shanghai and a little bit further south than that, you get some absurd percentage of the world's population. And there's no need for any of them to trade in US dollars anymore, full stop. And actually, virtually all those countries are living in a deflationary boom of which the Western world participated in from 1980s until COVID. So, there are also opportunities in the Western world as well. But where do you want your capital to live? You definitely want a proportion of that capital, particularly if you're worried about inflation in the Western world. That's a great place to park some long-term capital.
That's a great segue. I mean, maybe we can talk now markets and US exceptionalism or not, and emerging markets or not, and the US dollar or not. We kick off with Stephen before I bring in some charts, or we go kick off the charts and then to Stephen. Well, let me just go back to some of those charts. So I think the really interesting phenomenon around markets is that this first chart, just before moving on to markets, you spoke about debasement. Clearly, we had US government bonds selling off, particularly in these BIFs, as they're called, the Britain, Italy, France, and the UK worst of all. Germany still looking relatively stable. And then, come in. You're just in time to discuss markets and emerging markets. That's your chair. and this, I think this really interesting phenomenon for portfolio construction people has been the lack of a safety trade in government bonds at all. And the fact that we're just coming off a month which was the worst month for the balanced portfolio, the 60/40 portfolio, since 2022. So what's going on with government bonds? Have people got religion in terms of these, the budget deficit being untenable, or is it still a safety trade? It seemed like when people wanted to hold US assets after the ceasefire just last week, they rallied again. Any thoughts on the bond question before we move to equities?
Well, it was correlated while because there was an inflation fear, driven by the war. I mean, my view on geopolitical crises is that they really don't last that long, and that people, to be honest, make fools of themselves into believing that this time it's different and somehow it shakes the fundamentals of everything we're doing. You read the headlines, everybody's in a total panic. So I wish we'd had this call 2 weeks ago, because I would have been saying then this is a great buying opportunity. There you go. So look, it is a crisis. We don't know how it's going to end. I personally believe that there will be a deal, but there you go. But even if there isn't a deal, it doesn't really matter that much. I mean, Saudi Arabia is able to pump 7 million barrels a day through the Red Sea. How much does Saudi Arabia export? 7 million barrels a day. So with one or two exceptions, principally the Qataris, everybody else can work their way around it. So I'm actually pretty relaxed, and I feel that we're in a very strong upswing here. I think it's broadening out. I agree with your views about emerging markets, frontier markets. If you look at the market in 24/5, it was highly concentrated. It was really a Mag 7. It was a tech play, which some people felt in that kind of narrow breadth is a bad sign. Now we're a much broader market. Even Europe's participated last year and the beginning of this year. I think all of those are quite positive signs, whether it's AI leading to a productivity boom, whether it's essentially a debasement trade, whether it's ultimately how many times is it right to fight the market. If you think about all our collective careers, not very often. Right. So there you go. So I'm think that one should have as high a weighting to equities as you can stomach, bearing in mind volatility.
To unpack that, I mean, just first of all, on the debasement trade, you would say therefore own equities at the expense of those bonds I showed before, which are selling off and no one has confidence they're no longer safety assets. I think there's a lot to unpack, of course, in what you said there in terms of the equity markets direction. I think it is notable that FOMO clearly is alive and well with equity markets. We've had, the 10th largest streak in the longest streak, winning streak since 2021. That was the post-COVID rally. We're seeing these basically markets, NASDAQ in particular, being a tech trade hitting the 10th day in a row. And as you mentioned, that has clearly followed in. And it seems also that those that markets are just generally saying, essentially thinking the war is over. Just to pick up on a few things, if you said it's generally relaxed, I'm not saying it. What about these alarmist headlines about 60 days left of jet fuel in Europe and cancellations of flights? Is this just the type of headline that will basically force a deal because it cannot be sustained? Or do you think that that's just kind of was the ambulance chasing or just an alarm bell?
I don't want to dominate the conversation, so please let other people
draw you out on your bullish equity markets. But just in terms of geopolitics, is the market right to be basically saying it's over and acting as if it's over, or do we have something more shocks potentially in the pipeline?
I'll come in later because I'm thinking rather longer term.
Yeah.
Well, let's just talk about Trump for a second. I think he's crucial, his personality. If you look at what happened in Minnesota, again, I bring up a rather unpleasant episode. So ICE was out there in force. There were some unfortunate activities, 2 deaths recorded. And there was talk about he could invoke the Insurrection Act and really turn the screw. What did he actually do? He backed away. I'm glad that he backed away, as it happens. So, some people call it TACO, some people call it the pressure of the midterms, some people call it actually the Republican Party, other people call it the Constitution. So whatever we like, trying to analyze Trump maybe is a fool's errand, but I don't think, although the tweeting and the sort of personality is pretty extreme, if you look at the hard decision making, he's got a bit of a track record in actually restraining himself at that vital moment. That's my view, but
yeah, I think it's going to be
other people feel very differently.
I think it'll be a short-term problem that the market will likely look through. Maybe I'm being naive. I think there's ways that could be worse, but I think that's what will happen. But I also think there will be ripple effects from it. Quite quite possibly this so-called inflationary episode of last month will turn out to be a deflationary episode. And actually the consumer is going to feel a real hit is currently feeling a hit that will reverberate for the next 6 to 12 months. A little bit in the US, more so in the UK and in Europe. So I think it will have repercussions, but not front page news repercussions.
I think that Trump's unpredictability means that things could escalate in the Gulf before they calm down. And it's not only Trump, it's Israel as well. They've clearly got another agenda, or 2 or 3. And Trump sees them as a very important ally and somebody he wants to support. So it doesn't mean that that things are going to get worse, but I just think it's utterly unpredictable in that area right now. Back to the 60 days of airline jet fuel. I don't think that's a colossal problem. I think that we're going to start prioritizing things if we need to. People will start prioritizing travel more. People already travel significantly less for business anyway. They can do that again. They can spend 2 years without doing business travel if they have to. I think that's been proven. And if it's an issue, then we'll just prioritize it. That's going to potentially mean a hit in the summer on a lot of economies that rely on tourism.
Yeah.
But that means that they also won't have people traveling, so it'll be a little bit out in the wash. So I'm not worried about the airline fuel.
Yeah, it's interesting, and that gets to the whole consumer weakness I pointed before, right? Because the consumer that's been affected by the higher gas prices is not the top 1%. It's the bottom of the K. They're the ones that are not spending. Those are the ones that are not. And I was just picking up my phone because the headline today I was looking at, you mentioned the market, the strength of the market. It's at an all-time high for the S&P 500, but only 12 stocks in the index made a 52-week high. So basically, that's since 99, we've only seen 5 readings this week or worse. So that basically points to the concentration. So it's clearly, and yes, it's broader, but it's not, and we're still looking at a fair concentration in the large tech. So it's not as broad. And if the consumer-led companies may well be affected by that. So I'd love to bring in the bear case, because I know that we've had some high-profile LinkedIn posts of the 40-year, calling the end of the 40-year bear market.
45-year bear market.
Okay,
Bull market.
sorry. What is the counter?
Right, let me start on valuations. I mean, we all know that US in particular valuations, I agree it's very concentrated, are at an extreme high. If you say it's not going to be different this time, you would expect 0 returns from equities. So you have to think it's going to be different this time to be positive about equities at the index level today. I take the point about broadening out. It's not, the very big stocks is not all stocks. There will be plenty of opportunities among the smaller ones. So that's my starting point. The second point, I think, is what's going on is basically Trump and the war. And this is maybe less important than my third point, but America doesn't have a strategic objective. Or if it does, please tell me what it is. And that makes me feel very like Vietnam. They've waded into this without thinking it through, and they're not going to win this. No way is America going to win this war. They're going to come out with they may kind of have some face-saving result, but it isn't going to actually help America. And for me, the really big conclusion out of that is that America's currently probably at the apogee of its power. And that power at some point, like all empires, is going to decline. It usually declines because they run into financial trouble, they can't finance themselves. And I think what the war means is just going to happen a bit quicker and a bit faster than it would otherwise happen. Now, the third point, and I think this is also really important, is on the financial side, is what we've had 40 years of, that's not quite, 25, 30 years of basically quantitative easing, where there's been more and more money going into the world. Walsh and Bessent are both saying they're going to try and stop that. They may fail, but I think there's a real risk that they're going to be less keen to use QE as a method of solving kind of financial problems in the markets. And there's a risk that either they do it too late or they do it too little, and they do precipitate a real financial crisis. So that broadly are 3 reasons why I am bearish.
And I guess So what is my question? Not that I'm not doubting, but if that is the case that you're bearish, where do you go? Because I think, as has been pointed out, bonds aren't a great alternative. And we can talk in a minute about real estate. Is that a great alternative? Equities, we advise investors who have to be somewhere, and they have to at least keep pace with inflation. That's or they're going to start losing. So where do you go?
It's not so much where you go, it's how you invest. And I think we have to learn the lessons back from the 70s. And I've been in the market for 43 years, but I've learnt from people, and there were mainly men, I'm afraid, who worked in the 70s. And it was much more about not riding, just trying to ride beta. You had to be more nimble. You had to be prepared to invest in something and then take profits quicker. You put more focus on arbitrage. So basically, and there was probably more opportunities about alpha in those days because markets were less efficient for the reasons we were talking about earlier. So that comes back to the question I asked earlier about will AI kind of make it even more difficult to get alpha? In which case you have to go to sorry. I think more difficult because everybody's going to have question, but everybody's going to have AI somewhere on their back in their back. They're all going to be saying, I'm not saying the same thing, but very similar results. I think it's going to be quite difficult.
Yeah.
I'm just to riff on that a little bit and to your question. I think the other consequence of 40 years, 35, whatever it is that we've been through is, and I look at it through the lens of what asset owners are doing, more institutional than retail, I guess is my experience. But when I talk to asset owners all around the world, the really big sense I've had since I started my career to today is they're more passive than they've ever been. There is more in buy and hold fixed income than they've ever had. And there's more private assets and kind of illiquid assets than they've ever had. And their decision making is much more set and forget long term, even if they don't want it to be, I mean, by nature of those investments. And so I think understanding that as a starting point is really, I think, important, because I think for me, that's a real explainer as to why I don't expect bonds to do well, not just the geopolitics, not just the inflation concerns or debt or otherwise. I think fixed income is what you sell in order to try and get some liquidity, especially if it doesn't offer you diversification at a portfolio level. And I think that's a big kind of pressure down on kind of bond prices, in my opinion. And then I think equities, it's not about in equities or out of equities, but I think there will be winners and losers. And I think index equities is what's likely to suffer. And so whether that's kind of whether that's alpha, whether that's more national winners and losers, whether that's kind of emerging markets or more developed, but a more active, targeted kind of approach to equities. I'm seeing a lot of asset owners who used to have very siloed approach to this starting to come together and kind of break down those walls to think more dynamically about allocating capital across those. And I think and that's kind of my final bit, that I think there's a governance kind of skill set uplift required, because a lot of those skills that might have sat in asset owners 25, 30 years ago isn't there today, to be more dynamic.
Right.
And to take more risk, to be more, to whether it's taking profits or hedges or otherwise. And so I guess I look at it through that lens too, and I think that's an important consequence of that.
I think the active side is important, but I think large Western companies, there is so much data on them, there's so much information that there is little value to additional research and to active management. And I don't think anyone's going to be able to outperform the AI within 12 months. Smaller companies where there is less information, there is less coverage, where there is frankly less thorough and complete management. If you're Alliance Boots and you need to hire someone in on AI, you go and get them. If you're a $50 million company, you might not be able to afford that person. So you're going to need someone who's going to help you. And that might be in the private equity side. All the leading managers are investing very heavily. I mean, JP Morgan across the bank and the asset management is investing hundreds of millions in AI. They're going to go in and they're going to help companies. So they're going to be investment banking advice to those companies, and they're going to help those companies. That's where you're going to be able to see potential for outperformance. So smaller companies, Also, developing markets. I think Asia has a lot to offer right now for pretty much the same reasons, as well as the fact that maybe they are better placed to take advantage of some of those opportunities that AI is bringing as well. But again, they're less efficient markets. There's more opportunity to help those companies and improve them and bring them up. And one of the issues that Mitesh touched on was diversification. The diversification between Europe and the US is entirely about sectors. The fact that the US is just more tech. If you look at the sector divergent or correlation between sectors between US and Europe, it's very, very high. So if you want to change, if you want to put more into the US or less into the US, you are necessarily taking a sector position. And if you're going to do that, well, then do it consciously. Don't do it accidentally. So I think more diversification, more focus on companies that are going to get more support from their banks, from their private equity backers, or for their active backers, whatever you want to call them. Those are going to be the opportunities for outperformance. But indexation is only going to grow at the larger end of the market.
The best hedge to inflation, companies that have pricing power, because for them inflation is a tailwind. But now identifying those companies, particularly in an environment that is probably going to, have revolutionary change, is very challenging. But that's your best hedge to inflation.
Yeah, and that's an engagement thing. And sometimes that actually cannot be. You get pricing power through brand loyalty, through engagement, not just through scale. There could be, and sometimes that is a person. You cannot replace that. I think I want to just bring in one point that I think ties to something we're observing, at least in the private wealth side, is that investors are less inclined to be the kind of hot money now. They are, maybe there's inertia, maybe they don't understand, maybe they're being well advised by their financial advisors, but they're not tending to exit on a panic, that maybe they recognize it's just not possible to buy that call exit. And so they're actually being more stable. Does that mean the other trend I think that's key is customization, and whether it's custom indices or custom products. And so that gets you a little bit away from the index, but it also gets you, you could still be inert and be customized. You just don't have to, someone will have constructed it for you, which gets to that kind of service layer. Because you can sort of set it and forget it with your customization, but that might be a way to kind of get to the culture. I just am conscious of time, not to run over too much. But one last section I had here was on real estate, because there was quite a lot written recently about whether real estate was essentially dead in the water. This is just a discussion of sectors. Speaking of we've spoken about AI, obviously the banks are doing well. Maybe that's because they're making all these investments. Was that on house prices? Been a lot of kind of existential angst, I'd say, around real estate as I'm never going to own it again. We've got recent tenant protections here in the UK, buy-to-let markets up in question, massive stamp duty, a lot more supply in the market. I heard a statistic this morning on a Bloomberg podcast suggesting that over the last 20 years, only London has actually kept pace with inflation in terms of the house prices, not anywhere else in the UK. That's obviously an average. And we all work with investors, some of whom own real estate as their main asset, if it's their home, some of whom are institutions and will have had maybe a 5 or 10% allocation there. And it used to be thought of as an inflation hedge. Does real estate still have the same criteria, or is something really fundamentally different this time with its liquidity? And remember, we're getting echoes of the real estate liquidity problem in private credit today as well. So we're being always reminded that liquid real estate is not always liquid real estate. Any final thoughts on the death knell?
UK real estate, we were told that you should get on the housing ladder as quickly as you could and trade up at every opportunity, and that was a route to enormous wealth. I know plenty of people who made fortunes, never had a proper job, but just bought and upgraded real estate. And I think that game is over. Unfortunately, the government, not just this government, but the last few governments have effectively killed that. And I think residential real estate will be a very poorly performing asset class. The dividend will be the enjoyment of the property. Period. It won't be a route to riches. There are lots of real estate is an enormous asset class, and people have a habit of kind of bunching it all together. So let's talk about for a minute things like office. Office that we all thought was dead and buried, and that COVID was going to kill it. No one would ever commute, or God knows what. Actually, office is performing pretty well. Normalized patterns of behavior have returned, and what was once considered to be a complete dud, people talk about beds and sheds and everything else behind. So I mean, I think you need some real estate in your portfolio, and no doubt even the UK residential market will come back a little bit at one stage. It's not a get rich quick trade. It's a diversification. It is a little bit of inflation hedge. I mean,
real estate, there are real assets, and if you believe that inflation is the issue, then there's an argument for holding them. I mean, to my mind, I completely agree with what you say. I think you need to differentiate commercial property from residential, and UK residential is expensive.
It's a cost to hold it as well, increasing cost.
Yeah.
It's largely a leverage bet on interest rates, right? That's all. So if you don't like bonds, I don't know how cheap real estate's got relative to bonds recently, but last time I looked, it wasn't cheap enough. Having said that, the people that work in the property market are pretty depressed, so it's getting to the point maybe. But
in my ultra bearish world, there's an argument for saying we're not trying to make money, we're just trying to lose as little money as possible.
Preservation, yeah.
I mean, let's just get back to that if you don't mind, Paul. I mean, I think Stephen's put this very eloquently. I mean, it's all about productivity and earnings. If there's no earnings growth, then unless you're buying something really cheap on a value trade, you ain't going to make any money. I happen to believe, particularly in the mid to small cap sector, which I think has been overlooked, that's where the AI revolution is going to come. Should you buy Nvidia at $4.5 trillion market cap? I've no idea. I'm not sure, which goes with your view, William. But should you buy the Russell 2000, where all of those companies are going to have enormous opportunities to enhance their productivity growth? I think you should. Should you buy emerging markets? Same sort of thing happening in India, happening in Pakistan, happening in Brazil, all sorts of places that we think in our slightly arrogant Western way are kind of left behind by technology. They are not.
And just very quickly on that point, listening to a frontier manager the other day, the biggest benefit of AI they see potentially is just having the power of a GP to all the rural villages in the markets to look at.
Steve, I don't disagree with that, but the problem is that the equity indices are just dominated by the Nvidias, etc.
Yeah.
And my real question to you, actually, the bulls is you can see reasons why earnings growth among those really big companies is going to carry on firing ahead because they are becoming like monopolies. But at some point, won't the US government or another government start antitrust legislation?
So I remember Tim Breeden, I'm trying to remember which telco company was 10% of the FTSE All-Share Index back in the 90s.
Probably GEC.
Vodafone.
Vodafone, thank you. And Tim Breeden's comment was, seen this before, it's happened lots of times. Sorry, Tim Breeden was CIO of Legal & General, mainly on the index tracking side. Seen this many times before, these problems always resolve themselves. And that is, they go down again, or they just stop going up and everything else catches up. Nvidia is a case in point. Nvidia borrows money, lends it to someone to buy their chips, and they then invest some in the next AI company over here, which is using the chips that the other guy just bought. It's not a Ponzi scheme, but it looks more like Japanese equity markets in the late 80s, where every company owned every other company. And that unwinding was painful, and we're still seeing the results of that. That is going to come unstuck, but it's not going to be in the next 6 months, maybe 4 years from now.
Yeah, I agree.
But it's going to take some. So I know that's drifting back off of real estate. Stephen's point about office real estate doing well. I got to be honest, I've been quite surprised by that, and it's been fascinating to watch it. I was very surprised at how much effort people put in, and the government talked about it, but frankly, the government did nothing. The American banks drove it, and they wanted their people back in the office, and so other people came in to deal with them, and that's been driving it. At the same time, where I am, Beckenham High Street, before COVID, there were 15 charity shops. Now all those charity shops and empty buildings are cafes, restaurants, and coffee shops. Well, people saying, do we need another coffee shop? Well, no, we don't, but we don't need another empty building.
Mm-hmm.
And those coffee shops are in use. So there are still people living suburban, and they're actually boosting those local high streets. So that
it's called human innovation, you know, which is the point. I mean, you know, this is the optimistic take, if you don't mind me saying this, William, that actually somehow or another we find a way of reinventing ourselves, reinventing the high street, reinventing the office, reinventing communications through Zoom or God knows what, and that is quite uplifting. So
yes.
That's my. Should we leave it at that?
I'm sure that was going to happen. My point was that the index at the moment is going to go sideways for 10 years at best.
Well, in the interest of letting people get to their dinners and other appointments, this has been the happiest of happy hours. I think we have to agree. Fantastic discussion. Thank you so much. I think getting people interested in discussing markets, bringing different points of view into a salon like this was my goal. And I think it's been tremendously successful thanks to everyone's contribution, coming in different ways, different perspectives. Hope we can do it again. And thank you everyone for listening to the Markets Happy Hour podcast.